This plan uses 3 parts to build a simple investment portfolio. The 3 parts are exchange-traded funds, blue-chip stocks, long-term equity anticipation securities, or LEAPs together. They give you a balanced approach to the markets. This combination aims for safety, steady growth, a chance for bigger gains. The goal is not to get rich overnight. It is to build wealth over time with a plan that is easy to understand. First, you start with ETFs. An exchange-traded fund is a type of investment that holds many different stocks or other assets inside a single fund. When you buy one share of an ETF, you are instantly buying a tiny piece of hundreds of thousands of companies. This gives you immediate diversification. Spreading your money out like this is one of the most effective ways to lower your investment risk. If one company in the fund performs poorly, its impact is cushioned by all the others. This makes ETFs a perfect starting point for any new investor looking to build a stable base. There are many good examples of ETFs: SPDR S&P 500 ETF, SPY Vanguard 500 Index Fund ETF, VOO Vanguard Total Stock Market ETF, VTI Invesco, QQQ Trust, QQQ. These funds are incredibly easy to buy and sell, just like a single stock. They typically have very low annual fees. Why pick ETFs first? They smooth out the wild ride of the stock market. A single company can face an unexpected crisis. Its stock can fall dramatically. An ETF by nature is protected from that single-point failure. Over many years, broad market ETFs like SPY or VOO tend to rise as the economy grows. They capture the collective success of American business. For beginners, this passive approach reduces the stress of stock picking. It lets you participate in market growth without becoming an expert overnight. The single most important rule for ETFs is simple. Keep them as the largest part of your portfolio. They are your foundation. Think of this portion of your money as the bedrock upon which everything else is built. It should be the part of your portfolio that you touch the least. You buy it, you hold it, you let it compound over years and decades. The second part of the plan is to add blue-chip stocks. These are shares in large, well-established, and financially sound companies that have been around for a long time. These businesses are often leaders in their industries and have a history of weathering economic downturns. Many of them also pay dividends. Dividends are small, regular cash payments made to shareholders. Great examples of blue-chip companies include technology giants like Apple, AAPL Microsoft, MSFT Coca-Cola, KO Johnson & Johnson, J&J. These are household names for a reason. Adding a selection of blue-chip stocks to your portfolio serves a specific purpose. ETFs give you broad market exposure. Individual blue chips can offer faster growth and a steady stream of income through dividends. They allow you to concentrate a portion of your capital on the highest quality businesses. The third and final part of this strategy involves a special tool called LEAP options. LEAPs are simply stock options with a very long time until they expire. While typical options might last for a few weeks or months, LEAPs last for more than 1 year and often up to 3 years. This extended time frame makes them fundamentally different from short-term options used for speculation. They give you a long runway for your investment idea to play out. They are a powerful tool, but because they involve leverage, they also come with higher risk and should be used carefully and in small amounts. There are 2 basic types of LEAPs you can use. LEAP call, right to buy at a set price before expiration. You buy a call when you are bullish and expect significant upside. LEAP put, right to sell at a set price before expiration. You buy a put when you want to protect your portfolio. Puts act like insurance. For a fraction of the cost of owning the shares, LEAPs let you control a large position, magnifying potential gains, but also magnifying potential losses. Let's look at how to use a LEAP call. Imagine you are very optimistic about the future of a company like NVIDIA NVDA or an ETF like QQQ over the next 2 years. Instead of buying 100 shares, which could cost a lot, you could buy a single LEAP call option for a much smaller initial investment. This gives you exposure to the upside of those 100 shares. To be safer, choose a call already in the money, stock price above the strike. It costs more, but behaves more like owning the stock, reducing some risk. Primary rule: use LEAPs sparingly as a small tactical part of your portfolio. They should never be your main holding. Think of them as a satellite, not the core. They can expire worthless. Be prepared to lose the entire LEAP investment. Allocate only a small percentage of your capital to them. Use cases. Add leveraged upside with a call or buy portfolio protection with a put. They are a specialized tool, not an everyday one. Now that we understand the three components, let's see how they can work together in a practical way. A balanced and sensible allocation for a beginner or a long-term investor might look something like this. You would place the majority of your capital, perhaps around 50 to 60%, into your foundational ETFs. This large slice of the pie is dedicated to safety, diversification, capturing the steady, reliable growth of the overall market. The next slice, making up about 25 to 35%, would be invested in your chosen blue-chip stocks. Finally, the smallest portion, somewhere between 5 and 15%, would be allocated to leap options. Because this is the riskiest part of the strategy, it is kept intentionally small. This specific mix, say 55% in ETFs, 35% in blue chips, and 10% in leaps, is not a rigid formula, but a flexible template. Following a few simple safety rules is just as important as picking the right investments. These rules are designed to protect you from making large, emotional mistakes that can permanently damage your portfolio. The first and most important rule is never make leaps or any other options your core holding. They are a tool for the edges of your portfolio, not the center. Their potential for a 100% loss means they must always be kept in a small, manageable allocation. Second, always keep your individual positions small. This applies to both your blue-chip stocks, your leap options. A good rule of thumb is to not let any single stock or option position grow to become more than 5 to 10% of your total portfolio value. This prevents a disaster in one investment from sinking your entire ship and ensures your success is not dependent on any single outcome. This three-part strategy provides a clear and actionable plan for anyone looking to start investing wisely. It is built on a foundation of common sense and time-tested principles. It combines the safety of broad diversification, the growth potential of high-quality companies, and the strategic power of long-term options. Start safe with a diversified base, add quality with proven winners, learn as you go with small strategic moves. Begin today by taking calm, simple steps toward growing your money for the future.